The math of 7,700. Why Tom Lee's insane S&P 500 target is actually rational. Every headline you read right now screams pessimism. We have geopolitical tensions in the Middle East, oil sitting at $100 a barrel, and the friction of new trade tariffs. Naturally, everyone is waiting for the crash. But while the crowd is looking for the exit, Tom Lee, the head of research at Fundstrat, is looking at a target of 7,700 for the S&P 500. How can a person be so foreseeable, and how can that target be rational in a world that feels like it's on fire? Today, we're going to look past the hype and look at the actual variables driving this market. We're breaking down the math, the productivity shield, and why pessimism is actually the fuel this rally needs.
The rationale, the wall of worry. First, we have to address the psychology. In trading, there's an old saying, bull markets climb a wall of worry. When everyone is pessimistic, they move to cash, they hedge, they sit on the sidelines. This creates what we call dry powder. As long as the news is bad, but the corporate earnings remain resilient, that cash eventually gets FOMO. Tom Lee's foresight isn't about being a permabull, it's about recognizing that the market doesn't trade on good or bad, it trades on better or worse than expected. Right now, the bar is set so low by the pessimists that even mediocre news acts as a catalyst for a rally.
The engineering, breaking down the formula. Let's look at the engineering of the index. If you're a quantitative thinker, the market is just one big equation. P equals earnings times PE. To get to 7,700, you need two things, earnings, E, and a multiple, PE. The earnings, E, for 2026, corporate earnings have been revised upward. Analysts are looking at a floor of roughly $313 per share for the S&P 500. Despite inflation, companies are showing incredible pricing power. The multiple, PE. People say, the historical average PE is 16x, we're at 24x, it's a bubble. But is it? In the 1970s, the index was full of steel and oil. Today, it's dominated by high-margin software and AI firms. If a company has an 80% margin and a tax-advantaged structure thanks to the One Big Beautiful Bill Act, OBBBA, a 24x multiple is mathematically more rational than it was 30 years ago.
The AI shield and demographics. There are two structural pillars Tom Lee uses to support this rationality. The AI productivity shield. Think of AI as a deflationary force. If tariffs or oil prices raise a company's costs by 5%, but integrating AI agents reduces their labor and admin costs by 10%, their profit margin actually expands. The market is betting that U.S. corporations are becoming shorter on human labor and longer on silicon efficiency. The demographic supercycle. This is the secret sauce. The millennial generation, the largest in history, is now hitting their peak spending and earning years, ages 30 to 50. Historically, whenever a massive demographic wave hits this prime age, the stock market enters a multi-year secular bull market that doesn't end until that generation starts to retire.
The 2026 roadmap. So what is the play for the near future? Tom Lee has proposed an M-shaped roadmap for this year. The April rebound. We've seen the market claw back from the March dip as Q1 earnings proved the skeptics wrong. The jagged summer. Expect a correction. The implementation of new tariffs and the heat of the election cycle will likely cause a 15 to 20. Tom Lee's foresight isn't magic. It's a bet on American corporate adaptability and a massive demographic tailwind. Is 7,700 a guarantee? No. If oil stays at $150 or the consumer finally breaks, the math changes. But until the earnings engine actually stalls, the path of least resistance remains up. Thanks for watching. Don't forget to like and subscribe for more market analysis. I'll see you in the next one. Disclaimer, I am not a financial advisor. All content is for informational and educational purposes only. Investing involves significant risk, and past performance is not indicative of future results. Always conduct your own due diligence or consult a licensed professional before making any financial decisions. I am not responsible for any financial losses incurred.